Hi, it's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. It is the morning in the UK of Thursday, March 12th. And because we had two podcasts last week, and I'm in the middle of some travel and hence some of the bad lighting for those of you on video, this is going to be a 15-minute, slightly shorter podcast. We will be back with you next week with our normal length. We're going to have an exciting guest. And then in 2 weeks, we're going to be live in Washington, D.C., recording on the Wednesday. So that will be Wednesday, the 25th of March. So if any of you are in Washington, D.C., please join us in person. We'll be at a location close to DuPont Circle and looking forward to having some Washington, D.C. based guests that will participate in the podcast. So watch out for an invitation about that. So now with no further ado, let's bring up the slides for this week. This week's podcast, oil spill, as what has been very clear has that been the shock in oil markets in the aftermath of the outbreak of war in the Iranian area has caused shockwaves in markets. It has caused an about turn in inflation expectations. And then as a corollary of that, a turnaround in inflation rate expectations. This has all been quite sudden. We're also going to look at what the shock absorbers have been doing in this market, whether they have in fact been behaving like shock absorbers. And I think of that as some of the traditional shock absorbers, such as gold, risk-off assets to the US Treasuries. And we'll go from there to look at what the impact on markets has been. As usual, we will cycle through inflation, as I noted, the effect on interest rates that higher inflation expectations may be having. We'll look obviously at geopolitics, which is coursing through all of this, equity markets and other asset classes, and the impact that might have on your portfolio. Of course, oil shocks are the talk of the week and the inflation contagion from that. We will speak about whether this is in fact a temporary or likely to be a more permanent shock to inflation, really to upend some of the expectations and direction of travel that we saw that. Around that, we have the interest rate U-turn. We are still in the background having debates around AI. Some of this has now moved into a new era, an era of discussion around governance and safety, much more dominating the discussion rather than questions of replacement of humans or speed. And we know that private credit stress will still not subside. And we'll ask whether some of the current factors in markets, such as around geopolitics, are acting as a convenient distraction to some of those stresses. And as always, we will look at the portfolio impact. Looking at the oil spill, it's worth paying some attention to the price of petrol and diesel. This is in the US. We can see that there has been a spike. My daughter lives in California. I've seen some horrendous photographs of $8 oil or $8 gasoline prices, at least at the pump there. So clearly a shock to consumers, not something that would be in the President Trump playbook, and something that is likely to stir, again, discussions around affordability. Not just consumers, of course, affected by this, also importers, as well as anyone exposed to these prices. So likely to have a very direct effect on corporate margins and affordability across the board. We know that the oil market has been highly sensitive to geopolitical discussions. This is something we've noted in the past. There have been moves in oil markets that have reflected geopolitical uncertainty, even when that same uncertainty has not affected other asset classes. And we can see just how sensitive over the course of just one single day, this chart on the bottom right, how much the oil price has moved between 94 and 82 upon messaging from the Trump administration, in this case, from the Energy Secretary around the Navy escorting a tanker through the Strait of Hormuz, when that was later disproved. So that caused initially a drop in the oil price. It looked like some of the supplies would be addressed, and then there was another increase back to the trend line there. Inflation, on the other hand, besides oil, has been steady, bearing in mind that this is a lagging indicator looking backwards, and that this was quite steady at 2.4% in February. We had some spikes, unexpected spikes popping up where they had not been expected in such as food prices in the UK. We'd seen it in Europe, but otherwise we had a steadily trending downwards inflation direction. And this is why we were so secure in some of those interest rate expectations, which have now been radically upended as a result of some of the oil price and gas price changes. What we have also been discussing in terms of shocks have been the backup plans. And this has been a fascinating insight into which countries had essentially sufficient reserves and numbers of days of oil imports in reserve to provide for an eventuality just like this. We can see from this chart that the Netherlands has been particularly high, but that all Asian importers had generally over 100 days of net oil imports covered by their stockpiles. When we get to Europe, those numbers started to drop, but they were still meaningfully significant to be able to cushion the blow of a short-term cut in supply, as we've seen right now. We have seen that Japan has announced it is releasing oil from its strategic reserves. And we've also heard that China has had significant preparation in place for an eventuality like this today, that they have also had significant reserves in place, and not only around oil, but other shock absorbers too in the economy to provide for this kind of eventuality. We have had other tangential effects, such as the refusal of insurers to insure the tankers in the Straits of Hormuz. We've also heard anecdotally that some insurers will insure a Chinese flag vessel, that there is a war insurance, that a war clause that will come into effect, and that may certainly will be expensive, but it would still apply on the basis that a Chinese flagged vessel would be unlikely to be targeted going through the Straits. So a bit of an a la carte approach to insurance in this very uncertain, foggy war, the prediction game at the moment. This has had, as I mentioned, a knock-on effect on interest rates. We've already seen a quote here from the Financial Times that hope for rate cuts across a string of big economies have diminished. The market is now expecting at least 1/4 point rise from the ECB by the end of the year, where before the conflict there had been modest hopes of a further cut. So we're even shifting to the discussion of rising rates. We can see these two charts showing the yield of the US 10-year Treasury that has risen above 4.2, back again to heights not seen for some few days ago, but certainly come down from lows of 3.9 we saw around the end of February. And in the UK too, we've seen the gilt yield up around 4.2%, so jumping as oil prices surge. What is notable here is this is very much, of course, a global contagion around interest rates, the spike in yields at this long end. We are seeing that this is not necessarily a reflection on individual economies, but just a global sense that because of this shifting inflation picture. This is fascinating, as this has just been a matter of days that these spikes in the oil price have already upended inflation and interest rate expectations. I would suggest that central banks are much more focused on medium and long term. They've already admitted that there is a fog around their data and around their ability to predict market events. That has been the case for some time. We have even had no data in the case of the Fed for some time. So I would suggest that this is not necessarily going to reflect their policy. They will be data dependent, and they're also highly sensitive to reaction to transitory measures, even though that word has become quite loaded in the aftermath of COVID. It's suggesting that certainly since President Trump continues to speak in terms of weeks, not months, and certainly not a bedded down long-term engagement in the region, that these effects on the oil price should be more short-lived. We know that US itself has its own supplies of oil, and we also know there are certain levers, whether it's around sanctions on Russia or around Venezuelan oil, that they could push on in order to try to affect the supply there. So lots of ways to alleviate some of this shortage, and suggesting that central banks are going to be so knee-jerk and swift in reacting, I think is quite short-sighted and is not reflecting the way these institutions have actually started to think. But it is also notable that these government bonds are not seen as necessarily a safe haven in the current conflict. They are selling off, the rates are adjusting, and that's a sign perhaps that investors are looking elsewhere for their safety trades. And as we'll discuss later, gold itself is also not turning into a safety trade at the moment. Again, just more shocks in terms of the theater of the unexpected. What we can see here is that Iran, because now Iran controls the Straits of Hormuz, it is exporting more oil today than before the war because its own ships, just as I mentioned, the Chinese flagships might be permitted to go through, it is letting its own ships carry its crude go through, and it has been presenting a scare to others. So that is perhaps something that is quite unexpected. What we've also seen as somewhat unexpected has been the persistence of the drone attacks, even on Middle Eastern neighbors, but the fact that the Middle Eastern neighbors have not put pressure on the US administration to stop its attacks. They have proven to be quite resilient in averting those attacks, or at least preventing them hitting populated areas. And we've seen that there has been more resistance perhaps than could have been expected. And then when we look at China's own, related to China's own sources of oil, we can see that Russia and Brazil have gained a share in the mix of China's use of oil since 2021, that the Middle East has now fallen somewhat dramatically in terms of its provision to China. So there was some discussion that the action in the Middle East was as a way to put pressure on China indirectly, and certainly in terms of deterrent and in terms of signaling of US military might, that will have an effect likely, but it's unclear that the effect on the oil supply will act as a deterrent or as even any kind of a lever. Moving to where some of the safe havens are, gold is actually down 2% since the conflict, so not really proving itself as necessarily a safe haven in a flight to safety, arguably because gold has been such a destination for risk on trades as well as for hedging in the past year and a half. Maybe it's already had its run up, maybe it's already proven itself in that respect, and there wasn't necessarily a perception of it being underbought and it being particularly good value. So that has been ticking along. It has not been selling off, which has been notable. We know that there was some action in gold by central banks, by Chinese retail investors. The fact that it is not sold off is somewhat interesting. We know that the treasuries, as I mentioned, have sold off, and the dollar itself has had some volatility. It has strengthened to some degree, but there is not necessarily a very notable trend in the dollar being a safe haven currency in this respect. We are seeing that markets still have a hunger for raising capital, and certainly companies do. They are looking at windows. We know that the IPO window is looking a little bit less open given the movement in markets and some of the volatility, and certainly the uncertainty, particularly as the conflict winds on. And we know that there could be disruption to supply chains that result from that. So that uncertainty is not conducive to a very fertile IPO market. But we also know that when it comes to bond appetite, that there are limited windows, and we can see that there were record bond sales, nearly $50 billion on Tuesday of this week, with total issuance topping 65 billion, as Amazon had led the charge there in issuing. So again, companies being opportunistic, taking advantage of calmer markets, and again, indicating just that pent up demand on the sidelines for not only equities, but also for high quality fixed income in a market where increasingly more opacity is coming into some of the less well-known and well-telegraphed areas, such as, say, private credit. Equity markets themselves, I've used the term plumb for a bottom. I wouldn't say that means it's at any kind of a major notable bottom, simply that there's quite a lot of volatile movements moving around in the aftermath of the beginning of hostilities, and even since the end of 27. We see that the 27th and the end of February, we can see that there has been reasonable volatility in the equity markets across the board, the Dow, the S&P, and the NASDAQ, but always recovering. So we do see that pent-up demand, the money market fund demand, the investor demand to buy on a dip. There have been countless calls for the SAS sector to be bought on a dip. So quite a bit of uncertainty. We've seen AI get discussed as perhaps being overstretched, over capacity, but we've also had continuing strong numbers come out of that sector, particularly in the hardware side. So I'd say very mixed messages from markets, but overall not exactly overall negative as after the outbreak. We have seen in terms of some of the sell-offs, China itself we can see that China itself is accepting some slowdown, and we know that this is a new music coming out of China, that there is going to be some realism when it comes to numbers there. Some of this is relating to the GDP, and some of this is just relating to perhaps a recognition around the exports from China. So not a particularly, I'd say, uniform picture coming out of China, but one to watch, because we do know that there has been accusations that some of these numbers in the past have been trumped up. We're still talking about private credit and still trying to get to the bottom of whether there is some kind of a systemic problem within private credit, or whether we're looking at isolated incidents. We know that I'd say that the rattling has continued to get louder in terms of calls for an examination of underwriting standards, suggestion that we've seen particular companies selling off, and in fact, entire fund complexes selling off as they were exposed to SAS or to software to a degree that was perhaps too concentrated for an investor to tolerate. There have been Goldman executives suggesting that the private markets client is glad to have an iron war distraction, suggesting that the conflict is now taking some of the sunlight, or at least some of the flashlight off private credit and private equity. They will go back to being in the shadows and doing what they do, far from the inspection of public markets and media. There's also, we have more cockroaches cropping up, not only in the US, but in the UK. MFS, we had this lender, which was recently suggesting they were refinancing merry-go-round in terms of red flags, that there was very loose underwriting standards, very unclear levels of due diligence, and really just the same kind of sloppiness that we've seen from lenders in every financial crisis. That this was the case then, as it is, as it has been suggested, is the case in some areas now. And finally, just to talk about AI slightly. So what we've had is an evolution of the discussion around AI. It has moved on from the discussion around the CapEx build and penalizing, in some cases, companies who'd been seen to spend too much on CapEx. Perhaps we did just see Amazon successfully get their bond issue away. Amazon, another area of a cash-rich company, but one that is still really amping up its cash flow, its CapEx needs when it comes to AI. We also saw the likes of Apple being more rewarded, as it had tended to go against the trend and instead outsource much of its AI development and not pay for that and build it in-house. So we have seen skepticism regarding that. We've also seen skepticism regarding the march of AI and the Mold book to the Claude bot to every sector in a cascade being hit by the fears that it would be replaced by AI, and in very short order. As I mentioned, we've seen some bottom fishers suggest that has been overdone. We've also seen reports that AI, in order to promote its integration into companies, that the consulting industry, the management consulting industry, has been very well employed in order to spread that message, essentially, that missionary message of using AI within companies. So that sector, perhaps the rumors of its demise had been stated too early. So where we have moved on now with the explosion of tensions between Anthropic and the US Department of War, and the subsequent designation by the Department of War of Anthropic as a supply chain risk, one of the first US companies to ever be designated as a supply chain risk, because of their red lines that they drew in terms of their permitted use of AI with them by the Department of War, and particularly around drones, as well as surveillance of the public. And we know that drawing of red lines really just, I'd say, kickstarted a conversation around governance. And increasingly what we are seeing from large companies that have integrated AI for some time is they're now getting increasingly concerned about their ability to constrain what they have built, essentially. And that will be the next set of dialogues that we are likely to see cascading through our AI discussions over the next, I think it's weeks, because every AI news cycle has tended to happen in weeks. So we are looking now at AI companies themselves concerned of what they have created. We've also seen suggestions in the headlines this week that Claude had grown a conscience, that it was starting to feel anxiety, that this was now the step into consciousness. And the other point we had also seen around AI and writing is that the majority of writers seem to prefer to read AI writing. So whether that is a pivotal moment in terms of AI's ability to now replace writers, or it is simply a suggestion that now the human it now needs to move up in terms of curating and editing, and really not having to spend time in the writing mode, but also being able to generate a lot more content. What it does mean is that content like this, like podcasts, like our thought pieces, will become much more frequent, and there'll be a lot more to wade through, which leads us to say thank you again for your attention to this podcast. Thank you for listening, and we look forward to seeing you next week.